Hello and welcome to my next War and Markets episode. Today's market was again generally positive market with Nifty being up about 0.87%, mid cap about 0.5%, small cap again 0.8, and micro cap a little bit better at 1.06%, right? So clearly, broader market outperforming the larger cap market. The advanced decline ratio again was almost 1900 to 1100. So clearly, advances were more than declines. Putting these two together, one would have expected that it's retail and HNI buying which has supported it. Because when you look at the flows, right, I think FII flows were negative almost 1,900 crores, DI flows were positive 2,200 crores. So clearly, the trend of FII buying last week, which was there, is now slowly translating into their selling, and DIs, which was selling, is translating into buying. But today they matched themselves 1:1. In fact, if you look at the performances today and track it through the day, you can see that the Nifty and the mid cap index, all of them started low, went up high during the day, and I think at the end of the day, the mid cap kind of eased off a little bit, and large caps actually retained that. So clearly, what it shows is that it was a very volatile day, but the volatility index itself was down today at 17.53 number, which is about 6% less than previous. So naturally, today was an expiry day from the F&O side. So a lot of the actions were surrounding that in terms of the sentiment of traders. What does this actually reflect? Well, first of all, we are close to a very, very important deadline as far as the geopolitics is concerned, the ceasefire ending. The second round of talks, well, America is apparently sending the vice president over to Islamabad. But as I speak today at 8 p.m. On the 21st, there is no confirmation that Iran is going to join. In fact, there's news that China is joining the talks to help them to resolve the war. So a lot of news flows. Mr. Trump continues on his what do you call blow hot, blow cold rhetoric, and says that if the ceasefire is not extended, he'll get back to war. But if you look at the one market which should tell us what to expect from the war, that's the oil market. And the Brent crude has remained fairly stable at 95. So it gives us the feeling that the market has discounted the war to some extent. Second is that the market does not really expect an escalation, and one way or the other, the pressure on Mr. Trump, both politically and economically, from the fact that gas prices have risen, his popular rating is dropping, the war is proving expensive for America, and I think we are nearing that 60-day deadline before which he has to go back to Congress to get approval to extend the war. So there's a lot of pressure, and I think the markets, and if you look at it, I think the American markets were generally in the green. So there's an expectation that something would get solved as far as the war is concerned. But as far as India is concerned, I'm seeing that the GIFT Nifty is slightly negative. So to some extent, that indicates that foreign players who want to participate in Indian market do it through the GIFT Nifty, and they are a little bit hedging their bets and not being that bullish because of the chance. So clearly, then to summarize the day was that it was again a retail-driven day. And if you look at the sectoral performances, you can clearly see that earnings season performance has driven this play. Now, yes, on the one hand, you can say that DIs would tend to read into the performance and buy those sectors. So for FMG, for example, I think Nestle came out with fairly good results today, and on the back of it, a lot of the consumer-related stocks rallied. So I think that the market will be in that situation where a bellwether in a particular sector reflects something good, then the whole sector gets affected. If the bellwether reflects bad, then get affected. So in that sense, the volatility will be very high because people who are like DIs generated a little bit of cash over the last few days. So they're waiting to deploy, and when this news comes, they tend to go and deploy. But probably retail also follows them very strongly. For example, in such a situation where, for example, rate sensitive like realty did well today, which is not very easy to explain, except for the fact that I think retail feels that the correction is overdone and they've gone and bought it. Because I don't think we're anywhere close to an RBI rate cut, right? Given the oil and the food inflation on the table, I don't think rate cut is on the horizon. But the realty sector has reacted very positively, probably because it's overcorrected, and again, retail participants probably feel. So to me, As a retail participants, right, they are clearly very bullish on the market because of the level of correction and are stepping into buy. Both FIs and DIs are being cautious at 1,000, 2,000 crores buying, selling, and in a wait and watch mode. So this, however, represents one bit of worry for me, that the extent to which retail and HNI participants are rushing into buy the correction. If things work out well on the war and everything settles, their decisions would have been fairly right. So they are taking a view on that. But if there's even a slightest thing of the war getting extended, and the ceasefire doesn't get extended, then there could be a whiplash effect in terms of the actual Brent crude prices and its impact on India. So they are running a slightly risky terrain. So to my advice still to retail investors is to stay buying small amounts in a staggered way, again not to pick sectors based on just the bellwether earnings, right? So I would say you can follow the DIS buying generally, which will come to a bit later in terms of clarity, but don't go and overcommit in this market. It might come off well if the war ends and everything is hunky dory, but it is a gamble. And so to that extent, I suggest that keep on staggered buying. That's what I've been recommending, and I'm not changing my stance. I think it's still the time until the clarity emerges for you to stay along that path, right? Thank you, and look forward to my next update tomorrow.